Dear friends, I hope you're all staying safe in these difficult times. After I posted my explainer video last week on the impact of the coronavirus on the future of money, many of you messaged me asking for my views on the broader impact of the coronavirus on the future of finance. So, in this episode of the FinTech Capsule explainer series, I'll cover 3 things that I think we should all be watching when it comes to the impact of the coronavirus on the future of finance. Here we go. First, fintech becomes financial services. The temporary bank closures and mandatory quarantines are forcing customers to conduct all their financial activities online. And once customers get used to digital banking, they're not likely to go back to the old ways of doing business. Banks that have been focused on their digital transformation by enhancing their digital services and improving their clients' user experience will benefit from the shift. But many banks have not invested strategically in either of those things, and for these banks, it will be a harsh awakening. The biggest competition for traditional banks may not be other traditional banks with better digital services, but rather the big wave of new digital-first banks that are coming to the market. The initial wave of digital banks were often startups, which had a harder time convincing clients to make them their primary bank account. But the wave of the digital banks offerings are often backed by large technology firms that consumers are familiar with, such as Tencent or Grab in Asia or Google in the West. They not only have deep pockets in tech expertise, but also brand awareness and to a certain extent, customer trust. That's a much bigger challenge for traditional banks and poses tougher competition. And with people being stuck at home, taking 5 minutes to open a new bank account online from the comfort of your couch is relatively easy to do while binging videos on Netflix. The one wrinkle for digital banks may be interest rates. Many digital banks try to entice new customers with attractive savings rates. With the recent drops in interest rates, offering such incentives becomes very costly. So these new digital banks will need to come up with more creative offerings to attract customers. Second, the future of the financial services workforce. The coronavirus may have a permanent impact on how and where the financial services industry works. There are many people in banks, especially non-client facing staff, that go to an office just to spend their days replying to emails or jumping on conference calls. Tasks that can easily be done from anywhere. And with everyone working from home the past few weeks, it became clear that many face-to-face internal meetings could be easily done by video conference. This may lead a number of banks to move a certain percentage of their staff to remote working arrangements on a permanent basis after the crisis. This would allow banks to hire talent from anywhere in the world, possibly restructuring their workforce. It could also enable banks to reduce a range of expenses, not only direct costs like pricing commercial real estate, but also indirect ones like the environmental costs of commuter transportation. This is not a new phenomenon. Many banks were already in the process of implementing remote or flexible work structures for their staff. But we should expect the adoption of such policies to be accelerated and more accepted across the industry following this crisis. Finally, number 3, the rise of financial health. Let me ask you all a question. You probably go to the gym for your physical health. You might pray or meditate for your spiritual or mental health. But are you using fintech apps for your financial health? If not, don't feel bad. Despite all the solutions in the market today, very few people are actually using them. There are heaps of financial health tools available. Some of them allow you to see consolidated view of all your accounts across different platforms. Others provide analytics on your spending habits. And others help you determine which bills to pay first or how to save intelligently by offering transparent savings products. Unfortunately, with the levels of unemployment that we're seeing from this crisis and more waves of layoffs that may come, people will need to focus more closely on their financial health. This is a serious problem, as a substantial percentage of people today are what we call financially unhealthy. For example, in the United States, over 57% of Americans don't have $400 of savings. Around 43% of Americans have credit card debt they've been holding for more than 2 years. And this data is before the coronavirus. So in the same way that many of us make a New Year's resolution to be more physically healthy and then decide to hit the gym, I hope that more people will have a coronavirus downturn resolution to be more financially healthy and look for technology offerings that can help. I hope this was useful. If there are any questions you want me to answer in these videos, feel free to ask them in the comments below. I'll try to cover them as soon as I can. For now, make sure to subscribe, and most importantly, stay safe, stay healthy, stay home, and see you all soon.